What's going on, guys? It's Jimmy here. So, all eyes are on Jackson Hole right now as the Fed is preparing for a major announcement right now within the next 48 hours. Yeah, and this is a big one here because this announcement is going to decide for, well, the whole country going forward which direction the Fed Jerome Powell, the head of the Fed, and the other Fed presidents, well, what they're going to decide for really the fate of the country, the fate of hundreds of millions of Americans, which way we're going to go. Are they going to continue to raise interest rates? Are they going to hold on them? How long interest rates are going to remain high? Remember that credit card interest rates are at all-time highs right now, around 25% just on average. And remember, that's just the average. Some people are actually even higher than that, 30%. Mortgage rates are at the highest they have been in over 20 years right now. And the federal government continues to pay more and more interest rate here pretty much by the month. They're nearing $1 trillion a year in interest rate. Take a listen here to how big this announcement is.
Eyes will be on Jackson Hole, Wyoming this week as central bankers gather in the mountains for their annual meeting. Joining us now with everything we need to know before the big trip is Yahoo Finance reporter Jennifer Schoenberger. Hey, Jennifer.
Good morning, Rochelle. As Treasury yields are trading near their highest level in 15 years, all eyes will be on Fed Chair Jay Powell's policy speech this Friday in Jackson Hole for just how hawkish the Fed is right now. The Fed minutes last week revealed that the majority of Fed officials were actually in favor of further rate hikes last meeting, noting that inflation still remained unacceptably high and most members saw, quote, significant upside risks to inflation. Since then, of course, a couple more inflation reports have showed more cooling. But with markets on edge, Fed Chair Jay Powell is expected to echo his message from the July policy meeting that inflation remains too high and that the Fed is committed to bringing inflation back down to the central bank's 2% target. Of course, the devil is in the details and the key will be in his nuances. Does he hint that the Fed is encouraged with the latest string of cooler inflation data and at a point where the Fed can move into an extended pause? Or will he set the table for still another one or two more rate hikes? Rochelle?
And we know we'll be passing through every bit of intonation in his voice there. Talk to us about nominal rates as well and the impact that they're having on real rates.
Yeah, this is very key, and your last guest brought this up as well. We've seen nominal yields on the 10-year Treasury go up over 4.3% this morning, as you mentioned, coming into the program. That means that real yields, which is adjusting for inflation, are bumping up against 2%. And bond traders have been telling me if real yields were to get above that 2% level, that could be problematic for the Fed. It raises the question of how they would filter that into setting monetary policy if the bond market begins doing the Fed's work for it. Of course, I'm going to be in Jackson Hole later this week. I'm going to put this question to Fed officials themselves to find out. And the other point I just want to make is that even though we are at or near the point where the Fed could move into an extended hold, the next very big pertinent question is how long will the Fed remain at those levels? Right now, perhaps the question is the market under anticipating how long they will see a 5 handle on the Fed funds rate? If it's longer than anticipated, that could create some market reverberations.
Also, more banks get downgraded as even more and more ratings agencies continue to see the problems in U.S. banks and around the world. You can see here shares of U.S. banks drop after now the S&P downgrades some banks, and this is creating a cascade of really pretty much a lot of banks across the United States and, as I said, around the world. Yeah, shares of several U.S. banks have fallen here the day after ratings agency S&P followed Moody's in cutting its credit ratings on some regional lenders with high commercial real estate exposure. S&P's action will make borrowing more costly for the banking sector, aiming to recover from a crisis earlier this year when 3 regional lenders failed, aka banks, prompting broader industry turmoil. Yeah, some of the structural aspects for banks regarding their balance sheets remain risks to banks as the Fed continues to try to anchor inflation with higher interest rates for longer. Yeah, they cut ratings to the Associated Bank Corp, Valley National Bank Corp, and it also downgraded UMB Financial Bank, Comerica Bank, and cited deposit outflow and higher interest rates. The rating agency also cut KeyCorp Bank on the back of constrained profitability. The rating agency also weighed on stocks of major banks, even though they were not mentioned. Shares of JP Morgan Chase and Bank of America both fell almost 2% immediately on the news. Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley each dropped already about 1%. KeyCorp, Comerica, and Associated Bancorp shares sank more than 3%, while Valley National and UMB Financial slid between 2 and 4% each. Yeah, so if you've been watching my channel, I've been reporting to you guys on almost all of these banks. We've been seeing hundreds, or actually collectively thousands, of bank closures on branches across the United States. I'll link you to one of those videos here I just did. We're seeing major problems here in the banking sector and the retail market sectors here across the United States. I'll link you to some of those videos here in a moment. And depending on what the Fed does here, could exacerbate this problem even more going forward here. If the Fed decides to raise interest rates here yet again, that'll be yet another blow to the banks and to Americans going forward here as they maybe continue to raise interest rates or continue to hold interest rates higher for longer. It's just going to be just more interest paid to and just affecting everybody here. This will include credit card interest rates, mortgage interest rates, auto loan interest rates, personal loan interest rates, student loan interest rates. It just means more money coming out of Americans' pockets and these banks, and then these banks have to turn around and then charge it to Americans, and interest just being paid all around, as most of America is already struggling. We got 2/3 of Americans living paycheck to paychecks. We have about half of Americans work their whole lives and retire with virtually no savings. And this is an absolutely brutal market right now. It's just, yeah, it's pretty bad here. The stock market has been doing pretty decent here. We're still near about a 1-year high. We had flirted with all-time highs here, but you know, the Fed just keeps pounding and pounding away on these interest rate hikes, and it's almost like the Fed is just going to continue to pound away until we see recession after recession for long term. You know, and a lot of analysts think that, you know, we're not going to really get out of the economy woes until we stop these recession or stop these interest rate hikes. So let me know your thoughts here in the comments. If you haven't yet, make sure to click the subscribe button down below and the bell icon so you don't miss out on any new videos. It's completely free to do so. New videos come out here every day, 10 a.m., 3 p.m., and 8 p.m. Eastern Standard Time. Thanks for liking and sharing these videos. You can click here to see all the banks that are closing and branches that are closing across the United States right now. Or you can click here to see Walmart, Target, and retail stores that are closing across the U.S. So click on one of those videos next. Thanks for watching, guys, and I will see you in the next video.